Hello everyone, I am Devang Chawda working as a part of product team at DSP Asset Managers. Today I'm going to talk about very important aspect of investing, which is asset allocation. When it comes to investing, majority of the investor wants to maximize the return, which is correct. And investor do in such cases, they try to go and pick stocks or funds which they expect to grow over a longer term. The asset class, however, which they focus on is mainly equity. And understandable as equity over a longer period has given significantly higher returns than any other asset class. But what investor misses out here is that along with fund and stock picking, asset allocation can also enable investor to maximize return, significantly lesser volatility and lesser drawdowns. How? Let's look at the table which is there on the left section of this presentation. So, as we can see from the table, none of the asset class have performed consistently. So, if you take a 24 years period, only 10 times domestic equity has outperformed other asset classes. Only 3 times international equity has outperformed other asset classes. Gold has outperformed 7 times, and debt has outperformed 4 times. Thus, it is clear from this table that every year it's not necessary the same asset class going to outperform. Now, and also if we see divide the period into various sections. So if we see from 2000 to 2002, debt was the asset class which was doing very well, and equity had underperformed a lot because this was a period when there was a period of dot-com bubble burst and also the September 2011 attacks. But when we see the period from 2003 to 2007, equity had outperformed every other asset classes. And again, in 2008, during the financial crisis, equity had suffered of minus 51% drawdown. And the same is being witnessed over the years. And even if we see in the period of 2020, equity had a very big fall. And during such time, gold as an asset class had outperformed well. So, though on a longer run, if we see the overall CAGR, domestic equity has performed well as compared to other asset classes, but there are period of intermittent volatility and drawdowns. Now, how do we minimize this? Can multi-asset allocation help investors to generate returns which are better than all these asset class? So let's look at some combinations which can help investor to get some useful insight. So now let's say an investor is able to time market well, and every year an investor invests into the best performing asset class. For example, in 2000, in the year 2000, investor had invested in debt. In 2001, also investor had invested in debt. In 2002, investor goes on in investing in gold, and so on. So if we see such portfolio, which is again very imaginary in nature because timing the market is not possible. But if we see the returns for this imaginary portfolio, it is whopping 28.7% as compared to what the other asset classes have given. So let's say even if let's say investor is not able to time the market well, but let's say an investor is able to do asset allocation with 50% correct timing. Even in such cases, investors tend to make returns which is more than domestic equity and all other asset classes. Now, even if we see lame allocation, wherein an investor invest equally in domestic equity, international equity, gold, and debt. So there also, if we see the returns are somewhat similar to equity, but obviously this will have very lower drawdowns and a very good investing experience for the investor. Thus, what we want to convey here is that investor needs to focus on asset allocation more as compared to stock and fund selection, as it is rightly said by a Vanguard study that asset allocation is responsible for up to 90% of the portfolio returns over the longer term.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.